Well, good morning, everyone. This is Liz Donaldson. I'd like to welcome you all to Nelson Mullins in the Trenches. I'm sure many of you have been joining us over the past few weeks. We're happy to have you back with us again today. Today, I'm joined by my colleague, Craig Nazzaro, who I know many of you have heard from on these webinars in the past. This morning, we're going to be talking about the Community Reinvestment Act, the CRA, and some of the changes that have come down the line in 2020 and the history that's associated with it. First, we're going to talk about what the CRA is and what it's trying to cover. We're going to talk about the differences between CRA and fair lending and where there are some overlap. Next, we're going to look at what types of matters that regulators are looking at when they are evaluating institutions at a variety of sizes, because the CRA divides up banks by asset size into three categories. After that, we'll talk about some changes that have come down the road both in 2016 and then this year in May 2020, the OCC's new final rule related to CRA. We're going to talk about some of the COVID-19 considerations and some interagency guidance that's come out in relation to COVID-19 and under the CRA. We'll talk a little bit about some mergers and acquisitions considerations, strategic planning as if your institution is moving towards M&A activity. And then finally, we're going to talk about some best practices associated with the CRA. Congress passed CRA as part of Title VII of the Housing and Community Development Act of 1977. The Act requires financial institutions of all sizes, consistent with their safe and sound banking principles, to serve the conveniences and needs of the local communities where they operate. Generally, the CRA requires all of the prudential regulators to examine the institutions under their purview, ensure that those institutions are meeting the credit needs of the entire communities in which they serve, whether or not those institutions are adequately serving low and moderate income neighborhoods. In assessing the CRA standards, examination staff has to consider certain additional factors, such as the business opportunities that are available to the particular institution being examined based on that institution's size and financial condition. Initially, this was set out into sort of two different categories: small institutions, large institutions, which has been expanded now to include intermediate small institutions, which we'll talk a little bit later about the tests that are applied to those institutions and how they vary based on asset size. The prudential regulators also consider the institution's CRA record and their history related to CRA examinations as part of the review, and that's must be submitted by the institution with respect to the deposit insurance if the institution is requesting a new charter, if they're establishing a new branch or home office, relocating a branch or home office, or during merger and acquisition activity. It's considered to be part of the merger application. So we'll talk a little bit more about what that looks like in a little bit. What the CRA does not do is specifically address how institutions should meet the credit needs of a particular community. All right, Craig, we're ready for the next slide. Importantly, the CRA is different than the fair lending laws, the Equal Credit Opportunity Act and the Fair Housing Act. But there are some significant overlaps. So we'll talk a little bit about how they overlap first. The CRA and the fair lending laws often overlap because in certain low to moderate income areas, there is often a significant minority population. So there can be some significant overlap in CRA and fair lending application. Additionally, because CRA and fair lending are linked because the CRA ratings can be downgraded in situations where there's a presence of some violations of fair lending laws, which can be this is broader than just fair lending violations to all legal credit practices, but fair lending laws plays an important role in that. But it's important to note that CRA and the various fair lending laws are distinct and very different. They cover different situations. The CRA requires that financial institutions make credit available across their entire community base, whereas the fair lending laws look at protected classes and aim to prevent discrimination against those protected classes. And the examination measures and associated enforcement mechanisms are different. For CRA, the evaluations look at the institution's lending performance, specifically looking at volume and the types of loans provided, whereas fair lending evaluations look to specific protected classes and whether or not there's discriminatory impact based on an institution's lending practices. So there are some important differences between them despite some potential overlap. And as you build out your policies and procedures and update your policies and procedures, you keep those key differences in mind when differentiating between the two different legal regimes.
And one other thing that we'd like to touch on here is CRA is interesting because over the next two slides, we're going to go into the CRA asset size, the threshold changes. But while we're on this one slide here with the CRA versus fair lending dynamic, you can look at the CRA as unique in the fact that it actually scales under the reg. Like a lot of the compliance controls, compliance org structures, fair lending org structures, there is no one size fits all. There is no, you're at this asset size, so this is what it should look like. You're at this asset size, so this is what it should look like. CRA is one of the regs that actually defines the institution's size and where it switches over to a different oversight, a different exam function, and how the examiners look at you. So it's important to think, when you're within each one of these sizes, how your organizational structures look. So when you're looking at this graphic here that was pulled from the St. Louis Fed, a lot of the times your CRA functions at a smaller institutions will be side by side by your fair lending controls. It might be the same person that's doing it. It might be one chief compliance officer with one or two direct reports, and these individuals are sharing some of the oversight for fair lending and CRA. As you grow and these roles start to diverge and CRA becomes more robust, fair lending becomes more robust, sometimes it falls outside of the org structure there. What you want to make sure as you scale that program is that CRA and fair lending are always connected through at least a dotted line and are working hand by hand. It's very important because as you start to scale some of the CRA initiatives, while they're looking to serve the same communities as a fair lending officer is looking to protect, if they're not working in tandem, sometimes you can get into a little bit of trouble with the CRA programs that you're rolling out, looking to promote lending within an LMI or promote lending to a certain community or certain community development initiatives. It can run afoul of fair lending laws if you're not looking at them through a fair lending lens. It's more commonplace to take place in a larger institution, but you want to at least have that on your radar as you're looking to scale, looking to grow, how those two controls are going to function at whatever asset size you're at. And with that, we can move over to the asset size threshold changes. So as Liz stated earlier, there's a small institution, an intermediate small institution, a large institution. We give a little bit here a background as to what they are currently. But we'd also like to just point you to this slide here where it's just a scale of where those asset thresholds stood over the last decade or so. And you can see it progress. Every year it goes up a little bit more. And when you cross that threshold, you're going to have different reporting standards. You're going to be looked at through different tests that we'll walk through in the slides to come. What's important to note here, if you're under these thresholds, particularly if you're under the larger threshold or just flirting with that asset number, you need to be above it for 2 years in a row. So you need to report on your call sheets in December of 19, December of 20, in order to be subject to them in your 2021 fiscal year. So you want to think about that and see where your target is and kind of anticipate it. You might not have the subject matter expertise within the organization to scale a CRA program. You may need to add an individual within the compliance group if you're going to look to build out a strategic plan, which we'll discuss in the slides to come as well. With that, I think I'm going to go back to Liz.
Regardless of the size of your institution, when doing performance ratings, the regulators have created a uniform 4-tiered rating system to assess CRA performance and compliance. And the way that you achieve one of these 4 varies by asset size, with the ultimate end conclusion that is uniform by regulator and by asset size as far as what the actual ratings are. So the highest being outstanding, dissatisfactory, needs to improve, and substantial noncompliance. And there's some sub-tiers within them, but those are the large tiers that address whether or not your institution has adequately responded to the needs of the community under your institution's size test. So we'll talk now a little bit more about what the different tests and different standards are, depending on asset size.
One thing I would add here, Liz, is as we were prepping for this and going through the OCC's new rule that they released earlier this year, there's some narrative in there around how the OCC supervised institutions shake out when it comes to these ratings. I believe in there it says that less than 3% of OCC supervised entities fall within the needs to improve and substantial noncompliance categories, leaving a majority of them in the satisfactory category, and less so in the outstanding. But I did think that was interesting just to see where your peers are. I mean, it's all publicly available information, but just to see it stated by the OCC was interesting.
So small institutions are evaluated for CRA purposes, whether or not they fit into which of those 4 categories they fit under, looking at what is called a small institution lending test. This test looks at the institution's average loan-to-deposit ratio and determines whether it's reasonable in light of the particular institution's capacity to lend, the capacity of other similarly situated institutions that lend in the particular assessment areas at issue. And I think that this is kind of, to go back to Craig's point, is one of the more important things. Part of CRA is how do you compare to institutions of your same size who are serving the same assessment area. There is a comparative aspect to this analysis. The third one is looking at the particular demographic and economic factors that are present in that assessment area and the lending opportunities that are available within the assessment areas. Once the regulators have looked at that, they're going to compare it to the credit that's been extended by the institution inside and outside of the particular assessment area at issue, and then review the completed distribution of credit throughout the assessment area and outside the assessment area with a final look at whether or not there have been a significant number of complaints related to the institution's CRA performance. To Craig's point, there's a lot of publicly available information on the regulators' websites related to CRA performance, so it's often an area where we do see complaints arise. Importantly, small institutions have the option to opt into the large institution examination process, which Craig's going to talk about a little later, which involves 3 different CRA tests and is a little more complex than the limited small institution lending test that is applied by default. Once your institution crosses the threshold and becomes an intermediate small institution, there are 2 different tests that are used. The intermediate small institution lending test, which we'll talk about in a minute, looks remarkably like the small institution lending test, and the community development test. It's important that intermediate small institutions are not large institutions. They're not required to collect and report CRA loan data on small businesses, small farm, and community development loans, but they can, like the small institutions, small intermediate institutions have the option to opt into large institution examination processes. And then importantly, again, this information is made available through the public evaluations process and posted on the regulator's website. So this is an area where it's ripe for complaints and concerns because the total number and dollar amount of community development loans, qualified investments, and community development services is going to be posted on the regulator's website. So there's some opportunity for public involvement here. So just something to be aware of. With that, we'll talk a little bit about what the tests are for intermediate small institutions. The first one is the lending test. It looks identical to the small loan lending test, looking at the capacity to lend, the capacity of similarly situated institutions, demographic and economic factors present in the assessment area, and the lending opportunities that are available to the institution's assessment area. So again, they'll look at that in light of credit extended in that area, the distribution of credit, and then a review of the complaints. So identical to the same lending test that's completed at the small institution asset size. then if you'll move to the next slide, we're going to talk about where it is different. So the intermediate small institutions have a second test called the Community Development Test, which considers, in light of the institution's capacity and constraints, the number and amount of community development loans and qualified investments. So this is starting to look a little bit more like the large institution test, which Craig will talk about in a few minutes. The extent to which the institution is providing community development services, including the provision and availability of services to low and moderate income persons. And they look here to branches and facilities that are available within those LMI areas. And then third, to look at the responsiveness to the opportunities for community development lending, qualified investments, and community development services in the particular assessment area. So they'll look at any assessment that's been done by the institution related to community development needs and opportunities within the assessment area. The examiners will look at the performance of the institution in light of the communities where they're operating and other governmental or civic resources that are available. And then they'll look at the combination of community development loans, qualified investments, and community development services in light of and in response to the particular community's needs and opportunities. So it is a pretty fluid and subjective test that is focused on the particular community in which the institution is operating.
So now we can switch over to larger institutions. So once you cross that threshold, the $1.305 billion, I believe, for 2019 or 2020, excuse me. You're looked at from the regulators as a large institution. So they have three tests: a lending test, an investment test, and a servicing test. You know, part of the confusion in CRA is how opaque the regulations are written. There's no bright line compliance with these three tests for large institutions. So you wind up with slightly different applications depending on who your EIC is, who your regulator is, what market you're in, and just how your bank is made up. What they do state is what they're looking at when they're conducting these tests. So the lending test for larger bank considers the number and amount of loans within your assessment area, the geographic distribution of the loans, including to LMI areas, your record of lending and lending-related activity to borrowers of various income levels, businesses and farms of different sizes, and then community development loans, the number and amount of said loans, the complexity and innovativeness of the loans. I mean, that's an extremely opaque term right there. And innovative or flexible lending practices to address the needs of LMI individuals or geographies consistent with safe and sound banking. Each one of the regulators go out of their way to say that they do not want you to go outside of your safety and soundness risk protocols. They don't want you to go beyond your risk appetite, but they want you to serve the lending needs under these bullet points. Part of what we're going to address when we get to the new OCC rule for CRA is how they started to address some of these concerns, like what is approvable as CRA lending under the lending test. It's also important to note here that it's very subjective depending on your EIC. So, you know, you could get great marks under the lending test, less great looking marks under the investment test, and you know, okay marks under the servicing test, and pass, and it can be any different makeup. You can do better on the investment side, less on the lending side, better on the servicing side, and less on the investment side, and still come out with a satisfactory rating. So part of what we want you to take away here is it's going to be about your documentation as well. What you don't want to wind up with is your regulator coming in, the FDIC, the Fed, or the OCC coming in, and asking about your CRA programs or asking about your CRA numbers, and you saying, well, you know, let me think, or let me go aggregate what we've done. You want to be recording all this as you go through, you know, thinking about when you what could qualify for CRA under the lending test, and kind of aggregating that and documenting it as you go throughout the year. That way, when you get to your exam schedule, your scheduled exam, you can have the discussions with the EIC, and it's less work for them. And you just have a better ability to get an outstanding or satisfactory rating. With that, let's move on to the investment test. So when applying the investment test, the examiners look at an institution's record of helping meet the credit needs of its assessment area, through qualified investments, which is a defined term within the reg, benefiting said assessment areas or a broader regional area that includes said assessment area. This also changes with the OCC rule as well because the assessment areas change. We'll talk about that a little bit, but it's good to know that even if you're not under OCC supervision, if you're looking at the FDIC or the Fed, you're going to be next up to be looking at that rule is going to be adopted or closely mirrored by the Fed or the FDIC eventually. We'll talk about the FDIC director's comments around the rule and why they opted out at this time, but we don't see any fundamental underlying disagreement with how to approach CRA under the modernization that the OCC put out. But while you're under the FDIC or Fed or the OCC until the changes kick in, this is what you're looking at here. So the investment test for large banks consider the dollar amount of qualified CDI loans, community development investments, which includes grants. The innovativeness and complexity of qualified investments, how much, what thought went into this, what kind of investments were rolled out, what kind of effort was put into it. The responsiveness of qualified investments to credit and community development needs. Were you looking at your footprint and your assessment area as to what may benefit them, and the degree to which qualified investments are not routinely provided by private investors. Are you supplementing as the lender within the community? This is where you start to see also the growth of the CRA role. So smaller institutions, CRA is basically looking for the loans that will qualify for credit, communicating those loans under the lending test to the regulator, and just waiting for your satisfactory rating to be issued. As you scale and become larger, your CRA officer becomes more of a community partner, and you have to have a kind of a program that mirrors that. You want to be able to show how you're thinking about the qualified investments, how you're thinking about the community needs within your footprint, and that generally falls upon the CRA officer to do. So it's good to know too, if you're just recently passing that larger institution threshold, that the CRA officer that you may find, or the person that you define as a CRA officer who is currently an FTE within your institution, may be good for your asset size at 1.4 as you just cross that threshold. But as you grow past that, as you cross into the 4-5, the $8-10 billion range, the individual is going to have a lot more subject matter expertise and show the regulators that that he or she understands the responsibilities that come along with this role to meet this investment test. You see very similar issues within the servicing test as well. This is the third test that the regulators will apply. The service test for large banks considers, again, the geographic distribution of retail bank branches, what that looks like within your footprint, the record of opening and closing of the branches, particularly how they serve LMI, geographies, and individuals. You want to make sure that you're talking about that. If you're going to open a new branch or close a branch, you want to have it documented that you discuss the CRA impact and the fair lending impact that those branch closings will how those branch closings will impact your institution. The availability and effectiveness of alternative systems for delivering retail banking services in LMI geographies. In the new OCC rule, we see that deposit-taking NPMs will be able to be leveraged to define your assessment area. So you kind of want to start to think down those roads. Like, what are you deploying? What resources are you deploying within your LMI geographies to help with the credit and servicing needs of those in the LMI area within your footprint? The range of retail banking services in each geography classification. Are you giving the full product suite across your footprint? Are you giving certain products in certain areas and not necessarily meeting the credit needs of other areas? The extent of your community development services provided. Again, this is where your CRA officer role starts to become more sophisticated. You're going to need somebody that understands what that community development services encompasses, what that looks like for an institution of your size, and what that should look like for an institution that you aspire to become. And then again, innovativeness and responsiveness of community development services that are out there. And with that, if you want to opt out of your prudential regulators coming in and going through these tests with you, you could always deploy a strategic plan. The strategic plans are great because, like we've been saying, that the regulations are kind of opaque. They vary from location to location, EIC to EIC, regulator to regulator. So if you opt into the strategic plan, all you have to do is meet the plan that you laid out and that the regulator approved for you. So to put in place your strategic plan, you have to do a couple things. The plan has to receive approval from your regulator. You have to have a public comment period on the plan, normally 30 days, and public comments have to be solicited. The plan term can be no longer than 5 years, and it must establish measurable goals for each of the 3 performance tests that we just discussed. So you have to put in, metrics for your servicing, metrics for your lending, metrics for your investment tests, and why those metrics would constitute a satisfactory or outstanding performance within those individual tests. This is a little bit easier way because you're basically reverse engineering how you get the rating. If you want a satisfactory rating, you're talking to your regulator ahead of time, saying this is how you plan to do it, this is how you plan to measure your success in getting to that goal, these are the metrics that you're using, and then all the regulator has to do is come in and make sure that you met those metrics, and you will get your rating. We outlined where in the regs you see the application and formation of strategic plans, where they can be found. We just outlined those at the bottom right there for you. With that, I'm going to turn it back over to Liz.
So as Craig mentioned, the biggest challenge with the CRA is that the statutes are written very vaguely, and even the examination procedures are unclear, and the processes, as Craig noted, depending on who your EIC is, the processes in place for examination are fairly opaque. So as you grow in size and look to develop more and more nuance to be moving towards those 3 different tests that the large institutions face, there's a challenge as to how you respond to what does it mean, for example, by responsiveness or innovativeness. And the regulators recognize that there's a lot of ambiguity associated with this. So for several years, they've published what they call the interagency questions and answers regarding community reinvestment. And the most recent of these was published in 2016 as interagency guidance. And they specifically provide guidance on the implementing regulations to the CRA. So each one is a question that is targeted at a specific aspect of the statute. And what they will do is reference the specific statute at issue and then provide a question and some clarifying guidance. The 2016 version of the Q&As was the most comprehensive since their original passing. They added 6 new Q&As and then added some additional clarities to some previously issued Q&As. They also did an update that removed all the references to the Office of Thrift Supervision because the changes since the previous rules that have been implemented. As Craig noted, though, there is some new OCC guidance. So there's some question about whether or not the 2016 Q&A still apply to OCC-regulated banks, or if this new rulemaking that was just promulgated earlier this year will override and overrule the 2016 Q&As. But for all banks that are non-OCC, this provides a lot of guidance. So Craig, if you want to move to the next slide, we'll talk a little bit about what some of these Q&As are. So on the screen, you can see what the 6 new Q&As that were published in 2016 are. The questions are very broad. For example, the first one is how do examiners evaluate retail banking services and development services under the large institution service test? It's a very big question. It does provide some nuance on how that is reviewed. And I think, though, let's dive into 2 of them in particular, because I think that they provide some specific guidance and give some color on what these Q&As look like. The first is related to the definition of responsiveness. So the third question addresses responsiveness to credit and community development needs is either a criterion or otherwise consideration in all of the performance tests. How did examiners evaluate whether a financial institution has been responsive? In the Q&As, the regulators emphasize that there are 3 important factors that the examiners consider when evaluating responsiveness. The first is the quantity, the second is quality, the third is performance context. So under quantity, the examiners look at the volume and the type of the institution's activities, so retail and community development loans, services, and qualified investments. The step one. In addition, the assessment is going to look at the qualitative aspects of the performance, including the effectiveness of those activities. And then finally, there's the performance aspect and whether or not the activities are responsive in that they are successful in meeting an identified credit and community development needs for that specific assessment area. So the Q&A provides some additional examples and walks through sort of an assessment of each of those areas and will help you as you build out policies and procedures to understand how the examiners are supposed to be looking at responsiveness and what that really means. The next one I want to look at in a little more detail is what is meant by innovativeness, and this is something the OCC has picked up on in their new rulemaking is this definition of innovativeness. And as the OCC, we've seen take steps towards promoting different types of activities, both under the CRA and otherwise, and sort of diversifying the types of services that their institutions under their purview can offer. We think that this kind of innovative concept will continue to grow. But we even saw that in 2016 with the passage of these Q&As, that the regulators, when they look at innovativeness, they're looking at innovative types of loans and investments and services. So they'll look broadly at all innovative practices and activities that can be provided by the institution to provide a meaningful improvement to the product, services, and delivery systems that they use to effectively respond to customer and community needs, particularly those segments that are within the definition of community development. So it's really about delivery and the types of products that you're offering. But they did caveat this and say that institutions shouldn't just innovate simply to meet the criterion and the applicable tasks that they're looking at, but they should be meaningful in that they emphasize serving, for example, LMI customers or distressed or underserved non-metropolitan middle-income geographies in a new or more effective way. And there's a lot of emphasis that this innovativeness is about effectiveness and the mechanisms that the institution is using in order to reach those particular customers. So in addition to those new 6 Q&As, interagency questions and answers, clarified and edited 9 previously published Q&As, primarily Q&As that had been published in 2010. And the changes in those focused on the availability and effectiveness of retail banking services, innovative and flexible lending practices, which is why I thought, it's this other guidance in the new Q&As related to responsiveness and innovativeness are helpful in evaluating even the old Q&As, because one of the things that was clarified in these 2016 Q&As is that some of the examples, depending on how narrowly they are drafted in the Q&As, can apply across different Q&As. So you can take an example from one Q&A and apply it to another circumstance. So there's a little more fluidness before. The provisions focused on community development related issues related to economic development, community development loans and activities that revitalize, stabilize underserved and non-metropolitan middle-income geographies. So there was a focus on loans particularly related to energy improvement that were picked up in these revisions. And then finally, responsiveness and innovativeness of the institution's loans, qualified investments, and community development services that they provide.
Next, we want to take a look at, we've been talking about the OCC CRA final rule that came out in May of this year. We want to go over, at least from a high level, of what that impact looks like if you're an OCC regulated institution, or if you're under the FDIC or FRB, what it means for you in the future, or what can you take away from it today. It's important to note that starting over the last couple of years, the OCC and the FDIC were working together. So as recently as last December, you saw the proposed rule come out from a multi-year effort from the regulators. But when the OCC released the final rule in 2020, FDIC didn't join in on the release. So the FDIC did release a statement. The second paragraph here from Chairman McWilliams is what I'd like you to focus on. She states that while the FDIC strongly supports the efforts to make the CRA rules clearer, more transparent, less subjective, the agency was not prepared to finalize the proposal at the time. And then she goes on to point out or raise COVID-19 as the driver for that. So in May, we were just going into lockdown. Stay-at-home orders were, still deployed across the country, and the FDIC thought, the smaller community banks are just not going to be ready to handle a complete modernization of the CRA, as well as the issues surrounding COVID-19, getting the needs of the community done that way. So they opted to not join in with the rule in May of 2020. I personally think that means that you're going to see the rules adopted in a very similar fashion by the FDIC, maybe the next 12 to 24 months, and same at the FRB, but, only time will tell there. So when the OCC did state the final rule, we put a link here to the rule when these materials are circulated to those that attended. If you want to read through the rule, or if you're an OCC regulated entity, I'm assuming you have read through the rule. From a high level, the four objectives that the rule tried to carry across was it looked to clarify and expand the bank's lending, investment, and services, collectively qualifying activities or CRA activities that qualify for positive CRA consideration. That addresses the concern that we were talking about earlier, where these are extremely opaque standards and vary so much. They're looking to normalize that across the industry and across the country. And when you go through it, they did a good job of getting you there. There's way more guidance within this final rule than has been collectively throughout the history of the CRA back to the late 70s. It updates how banks delineate the assessment areas in which they're evaluated. We'll talk about that a little bit more in the next slide. It also provides additional methods for evaluating CRA performance in a consistent and objective manner. So they're looking for, getting a lot of the subjectivity out of the EICs and the exam team's hands, when they're on site from bank to bank, and making it more objective. And it requires reporting that is timely and transparent. It changes the reporting standards a little bit, but that's a little bit easier to review individually. Two things that I want to call out, particularly in the changes, is the qualifying activities. So we've been saying it throughout, but to date, both banks and the regulators have evaluated the CRA performance of an institution without an illustrative list of qualifying CRA activities. Without that list, the activities have varied from bank to bank, region to region, and even over time periods. Or what was working in the late 90s is not working in the early 2010s. So this proposal provided a process to confirm whether an activity is qualifying before the commencement of the activity. It had way more interaction between the regulator and the lending institution, and included a publicly available, non-exhaustive illustrative list. We have a hyperlink there to that illustrative list, and it is really informative. If you have not read it yet, and you're a smaller institution, even if you're not regulated by the OCC, you should read it, digest it, and whoever is over your fair lending, your compliance, your CRA, should be tracking any activity that's close to activities on that CRA illustrative list by the OCC. While it may not be directly applicable under the FDIC or the Fed, because it's produced solely by the OCC, it's an extremely valuable piece of guidance. You should be almost mirroring whatever's on that list and tracking internally anything that comes close to what's on that list. Second thing we'd like to call out about the new rule is the assessment areas. So the OCC within the rule acknowledged that an increasingly large number of banks have, in whole or in part, adopted new models in which they collect significant deposits outside of their physical branch footprint. Brick and mortar footprints aren't necessarily what drives who your community is, who you're serving as a bank, what your mission is as a bank. The rise of internet banks, online deposit gathering, online loan originations, that's changed a lot of the strategic plans of institutions across the country. And the CRA was outdated in the fact that it didn't address this. It was very, difficult for someone who was gathering the deposits from a nationwide source and had maybe two physical branches in one state to get the CRA ratings that they were looking for, because it's, you know, your community is not around those two branches. So with that, they put out a threshold standard. So a bank that collects 50% or more of its total retail domestic deposits from outside its physical brick and mortar branch footprint now must delineate an additional assessment area for a location that it draws more than 5% of deposits. So if you have, you know, a small network of branches in one state, and if you get 8 to 10% of your deposits from that small footprint, that is a separate assessment area. And if you're over 50% outside that footprint, you can delineate, you know, a whole state, wherever you are getting most of your deposits from throughout that footprint. This serves the internet banks, it serves online originators, it serves banks that are partnering with fintechs more to comply with CRA. It gives them a much clearer roadmap on how to get the ratings that they need to continue their growth. If you're a smaller bank, it also should signal to you that the OCC in particular, this is another tipping of their hat that look, with these bank partnerships are here to stay. We believe that, you know, digital banking is the future, and they're going to update the regulation and modernize the regulatory framework to accommodate that.
So in addition to OCC's 2020 rulemaking, the other prudential regulators, including the OCC, got together in March of this year and released a joint statement on some CRA considerations in light of COVID-19 and the potential impact that can have on particularly branch banking. So this guidance looked at retail banking and retail lending activities within the financial institutions assessment areas and looked at ways that they could relax CRA considerations related to the responsiveness of those institutions to the needs of LMI income individuals, small businesses, and small farms who were particularly impacted by COVID-19. Again, all in light of the fact that the overlying concern is, you know, safety and sound banking practices come first. So the additional considerations that the regulators added that they stated they would consider favorably in light of and in response to COVID-19 are waiving fees, ATM fees, overdraft fees. Overdraft fees is certainly a large one where we've seen a lot of encouragement, and then early withdrawal penalties on any time deposits. Easing restrictions on cashing out of state and non-customer checks. A big one is expanding the availability of short-term and unsecured credit products. We've seen particularly the OCC, even outside of this joint statement, be very encouraging of their institutions to provide access to short-term credit, both in light of COVID-19 and more generally, to make sure that their banks are responding to the needs of the customer base where they're operating, and particularly in light of some of the credit crunches and unemployment numbers that have existed because of COVID-19. This has been an area of focus and encouragement. Relatedly, they've encouraged the increase of credit card limits for credit-worthy borrowers, again, consistent with safe and sound banking practices. Providing alternative service options to customers. So this is where we've seen them encourage the rollout of online banking products, mobile remote deposit capture, mobile banking products as alternative mechanisms, particularly where branches are closed, or making sure that there is some other form of access to banking services if a customer is unable to come into the physical branch. And then finally, offering sorts of payment accommodations such as deferrals, skip payments, in order to prevent and avoid negative credit consequences and delinquencies on currently outstanding loans in light of some of the credit issues and unemployment issues that have resulted due to COVID-19. Again, they also, in this joint statement, explained that community development activities could include certain specified activities, so such as loans, investments, and services to support digital access to LMI, individuals, communities. Again, there's a big focus on digital access because of the restrictions and inability for people to come into a physical branch. Same with access to health care and food supplies and services, just make the availability and investment in those activities. And then economic development activities that sustain small business operations in those areas as well. As far as timeline effectiveness, this is going to be effective for a 6-month period after the national emergency declaration is lifted, unless the agencies choose to extend it. So we're still in the middle of this, and it will continue for another 6 months following the lifting of the national emergency declaration.
And we think it goes without saying, but also, we've been trying to drive the point home that documentation is very important within a CRA program. And a lot of our clients, were moving quickly to assist their customer base or their borrowing population as we entered the COVID-19 lockdowns and, moved past March, April, May, June. Now that it's starting to become a little bit more normalized, you want to make sure that you're tracking all of these programs. Anything that you've done that may be on the list in this prior slide, like what we have outlined here, or any of the the economic development activities that will be upcoming as we start to dig out from the issues that we experienced in 2020. You want to make sure that this is all heavily tracked and heavily documented within your institution, so you can communicate these and how they benefit your CRA rating. When we get to 2021, you start to have regulators back on site. You want to make sure that you can communicate these efforts very clearly and very efficiently to the EICs to get the credit that you deserve for all the hard work that you're doing within the communities that you're serving. You want to make sure it's very easy to just hand that right over to the regulator.
And I think it's also important, Craig, just before you move on, that from a documentation standpoint, particularly with this impact on particular lending programs or the waiving of fees, that you keep good and accurate records of those also for fair lending purposes, because we anticipate that that's something that coming out of this crisis that the regulators are going to look at with some particular focus. So thinking about some of these actions you've taken from a CRA perspective and the impact that they may also have from a fair lending focus.
100% agree. We also wanted to discuss the M&A impact. So your CRA ratings, more so than almost your consumer compliance programs, will impact your ability to complete an M&A transaction or open up a new branch. We took an excerpt here from the INTERAGENCY Bank Merger Act application, and just to point it out. So they always ask, what your needs of the community are under the applicable criteria of the CRA, and they want you to include the needs of low and moderate income geographies and individuals within your footprint, and you should have a discussion around the following subpoints. So we'd like you to go through, A through D, the significant current and anticipated programs, products and activities, including lending, investments, and services appropriate to the applicant and the resulting institution, the anticipated CRA assessment area of the combined institution, the plans for administering your CRA program for the resulting institution following the transaction, if approved, and for an application of a target institution that has received a CRA composite rating of needs to improve or substantial noncompliance, institution-wide or where applicable in a state or multi-state MSA has received an evaluation of less than satisfactory performance within an MSA, how you plan to rehabilitate that. It's always good, no matter what size you are, to kind of put some thought and effort into how you respond to this subsection of questions. It's going to be brought up in every single one of your public comment periods going into a transaction. You want to make sure you can give the regulators the ammunition that they need, the narrative that they need to combat any issues that the community may raise in those community comment periods. And you want to put the regulators at ease that you've thought about your CRA impact. You have a strategic plan that is workable and should be easy to roll out. But we also want to take a look at when that doesn't happen or how they can leverage the CRA. So we want to take a look at the Bancorp South transaction. Bancorp South announced the merger back in January of 2014. It submitted its BHC Act merger applications in early March 2014 to the FRB and the FDIC. At the same time, the DOJ CFPB investigation that Bancorp South is going under traded negative public comments, forcing Bancorp South to withdraw its merger application on August 2014. They then resubmitted it again in early 2015, thinking they were beyond it. As a result of the CFPB consent order, the FDIC then retroactively downgraded the bank's CRA rating from satisfactory to needs improvement, effective as of the 2013 CRA evaluation. It's highly unusual, but they did it looking to, literally to block the merger. So then Bancorp South announced that it would be unable to obtain the necessary regulatory approvals for merger until its CRA rating was improved, and withdrew its regulatory applications on October 2016. So it's easy to Monday morning quarterback this, or look at it post-mortem and say that they should have had a CRA program in place, or that was kind of more bulletproof, that the FDIC couldn't retroactively downgrade, or that could counter any of their concern, any of the FDIC's concern about the DOJ CFPB's consent order. But it's important to know, just know that it's out there, that they can use your CRA rating against you retroactively. You really need to put this in the forefront, and have the regulators' confidence that you have this under control. So their ability is very limited as to how they can put you in a penalty box using CRA for any growth opportunities that arise. And finally, we do want to leave a couple of minutes for some questions if you want to email any in, or if you want to contact myself or Liz or Brad after the webinar, that's fine as well, or when you get these materials. But before we do that, we do want to go over some CRA best practices. Again, we've been driving this home for the last hour, but establish, document, and communicate your goals for CRA performance. You don't want to be gathering documents up and trying to rebuild what your CRA efforts were in 2021 and to showcase what your efforts were in 2020. You want to understand your assessment area, be able to communicate the competitive, economic, and other demographic landscapes of your market to examiners. Showcase that you've thought about it, that you've contemplated it from multiple angles, and that you're fully invested in your CRA performance. You want to continually monitor similarly situated banks or your peer banks to measure your institution against the market, against your peers. You want to maintain a strong fair lending program. As we opened this program, this webinar with, the fair lending and CRA are hand in hand. They're brother and sister programs that should always be sat closely within an org structure or through a dotted line within an org structure, and informing each other of that. As Liz mentioned earlier, a poor fair lending program and poor fair lending exam results will affect or impact CRA ratings. Outside of fair lending, you want to maintain a strong CMS, a compliance management system, that informs senior management as to your possible CRA risk. You want to show your CMS is contemplating CRA risk. You want to remember that other illegal or non-compliant credit practices also impact CRA ratings. Always consider and document discussions around CRA impacts associated with the opening and closing of offices and branches. We discussed that earlier. You want to make sure that not only did you bring it up in an email, but you documented it somewhere in one of your committees. You were discussing the CRA and fair lending impact of any branch closure or openings. And finally, you want to evaluate in depth that OCC final rule and its impact on your institution. Even if you're under that large institution threshold and you may not be subject to the OCC rule, you want to understand it. OCC may not be your primary regulator. You still want to digest it because, as I said before, I believe that the FDIC and the FRB are moving in that direction. And even if they're not, you want to still go through the OCC illustrative list for lending activities, so you can kind of inform your program and build your program around that list. It's the best source of ammunition you would have to explain to a regulator that's not the OCC, why you built that, why you believe that is qualifying lending activity or qualifying investment activity. So it's very good to point to that. So you want to look through that OCC final rule, digest it all, and the supplemental guidance that's with the rule, like that illustrative list. And with that, we'd like to see if there's any questions. And if there isn't, we thank you very much for joining. And there will be another In the Trenches series in 2 weeks from now, 2 Thursdays from now. But we'll give you a few minutes to email any questions in. And if you don't, Liz, do you have any final comments? Anything you want to add?
No, I think you covered it, and thank you everybody for joining us today.
And with seeing no questions, thank you from me as well. We look forward to seeing you 2 weeks from now in the next installment. Thank you very much, everybody.
Thanks, everyone.